What is asset allocation in family business investment strategies? Imagine trying to grow a garden with many different plants. Some need lots of sunlight, others thrive in shade. You want a balanced mix to keep everything healthy. That's similar to what asset allocation does for family business investments. It's about dividing your wealth into different types of investments to reach your goals while managing risks. In family businesses, wealth often comes from the operating company and other investments. Asset allocation helps balance these sources so the family's overall wealth stays stable and grows over time. It involves choosing how much to put into stocks, bonds, real estate, private equity, and cash. Each has its own risk and return pattern. Stocks might grow faster but can be more volatile. Bonds are usually safer but offer lower returns. Real estate can provide steady income and appreciation. Private equity offers high growth potential but is less liquid. Cash keeps money accessible but earns little interest. The first step in asset allocation is creating an investment policy statement. This document spells out the family's financial goals, how much risk they're willing to take, how soon they need access to cash, and any values or restrictions. For example, a family might want to avoid investments in industries they oppose or focus on socially responsible options. This statement guides all investment decisions and keeps the family disciplined. Families consider several factors when deciding how to allocate assets. They look at how much risk they can handle and what returns they want. Younger family members might accept more risk for higher growth, while older generations prefer preserving what they have. They also think about how different assets move in relation to each other. Combining assets that don't usually go down at the same time reduces overall portfolio swings. Liquidity needs are also important. Families want enough cash or easily sold assets to cover expenses without forcing sales of long-term investments. Another key element is aligning investments with the family's values. Some families choose impact investments that support social or environmental causes. Others avoid certain industries like tobacco or firearms. Tax considerations also matter. Proper structuring can help minimize taxes and boost after-tax returns. Family offices, which manage wealth for wealthy families, often adjust their portfolios based on market conditions. They use tactical asset allocation to respond to economic changes while sticking to long-term goals. Regular reviews and rebalancing keep the portfolio within the desired ranges. This means selling some assets that have grown too much and buying others that have lagged, maintaining the right balance. Practically, family businesses might allocate part of their portfolio to private markets like private equity and venture capital. These investments can offer higher returns and diversification beyond public markets. Technology tools help monitor performance and risk in real time. Educating family members about investment principles builds their understanding and helps them make informed choices across generations. Managing liquidity carefully ensures enough cash for business needs and personal expenses without disrupting the investment plan. In essence, asset allocation in family business investment strategies is about spreading investments wisely to support growth, protect wealth, and reflected family values. It's the foundation of long-term wealth management, helping families preserve their legacy for future generations while navigating changing markets and economic conditions.